And Wolf Street. Wolf Richter. Volatility in housing. What surges and crashes the most? Speaking of volatility in housing, when these markets are finally let loose by the central banks of the world, when they stop propping them, and you know they have to, and they know they have to, in later this year, just might be the date. Remember early on, I kept telling you this September 23rd thing in the movies kept coming up, but they never would put like the year, right? There's always this number. And so many of them were also had the sevens and the triple sevens and all that stuff. Which, strangely enough, this year, the sevens, Trump and his 7-day, 70th-year-old, 7-month, all that crap, just sevens this year are out of control. September 23rd, I thought, and it's certainly my opinion only, but it's based off of the stuff we see in the movies and things, that even though we didn't know the year that the last several years of 923 being shoved in our face, which year it was, I thought if I had to pick a year, I've said this before, it would be this year. And I think it still is. But it remains to be seen. We're just going to have to wait. You can't hurry doom. No, you'll just have to wait. 'Cause doom don't come easy. It's a game of give and take. You can't hurry doom. Oh, you just have to wait. 'Cause doom don't come easy. It's a game of give and take. I need doom, doom. All right, I'll say it for you. Damn it, Jason, you are a bozo. Thank you. Thank you. Volatility in housing. So what I was going to say with that, though, is when this whole market thing comes down, volatility in housing, you ain't seen nothing. Baby, you just ain't seen nothing yet. And I can hear many of you, why the hell did you buy that house, you idiot? I gave you the reasons why, and I'm not going to tell you again. I'll make it up on the backside with the cryptos, as I am actually successfully currently doing. Sold my Veritasium a little early to come up with a hefty down payment for this house. I still have some, by the way. I didn't sell them all. I only sold what I needed. Knowing it's going to double and triple, and I'm going to miss out on that. And I sure as hell did. But it's okay, because I still made a phenomenal return. So did many of you. And like I said, I'll be making it up on the backside. So you can kind of look at it as if I only put $5,000 down on this house out of my own money. And Bitcoin and, or cryptos gave me, 90 plus thousand in exchange for my 5. So it's kind of like I just got that for free to put down on this house, which takes the price down quite considerably, you know what I mean? So yeah, even if the markets crash, I still should have some freaking equity in this house, And again, it's our house. This is where we want to live forever. I don't care. I had to make this happen. I gave you the reasons. I just have to say that because I know the comments are coming. And even though I said that, I'm telling myself now, the comments will still come even though you've said that. So why did you just waste 3 minutes and 26 seconds doing that? And I gotta be honest with you, I don't know. Anyways, it says it depends on the value of the home. So volatility in the housing market. What surges and crashes the most? It depends on the value of the home. What happened? And I think I know where he's going. High-end housing, ooh, those crash the most. I got a sneaky suspicion. We'll see. What happens to home prices during the current housing boom and the next housing bust depends to some degree on whether the home is relatively affordable, whatever that means at today's prices, or more expensive. This is an important data point in the consideration for lenders that have to worry about their collateral value, and for the residential property investors and for homeowners who might want to get a foretaste of what is next. The CoreLogic Case-Shiller Home Price Index offers an index based on 3 tiers of prices: low tier, middle tier, and high tier. Like small cap stocks versus large cap stocks, the less expensive homes show much more price movements up and down. What's this? This is opposite of what I was just thinking. Is that what I'm seeing here? Like small cap stocks versus large cap stocks, the less expensive homes show more price movements up and down. Interesting. And are thus far more volatile during booms and busts than their more expensive counterparts. Now that is very interesting to me, because I remember for sure, and I know a bunch of you have shared stories with me yourselves about some of the high-end real estate. I remember houses, oh, this $1 million house was going for $1 million in 2006. I got the thing for 350. And I'm thinking, well, that's a lot bigger move than someone that had a $200,000 house and now has $100,000. So this is kind of odd to me, to be honest with you, because I've seen data that suggests the opposite. But whatever, it's the Case-Shiller Home Price Index. If they're saying it, I'm going to tell you like they say it. The Tiered Home Price Index, or TPI, comprises 16 metro areas: Boston, New York City, Washington, D.C., Chicago, Denver, Las Vegas, Los Angeles, San Diego, San Francisco, 5-county Bay Area, Miami, Atlanta, Minneapolis, Phoenix, Portland, Seattle, and, chasing it 4's, Tampa Bay. Prices in the low tier rose 10.8% year over year, according to the TPI, published in August. For mid-tier homes, the index rose 7.5%. And for expensive homes, prices rose just 4.8%. That principle has been true for the past 17 years of the index, covering 2 housing booms and 1 housing bust so far. The chart below shows how prices of homes in their, which I'll pull it up in case you want to see it. The chart below shows how prices of homes in the low tier, which is the yellow line, rise much faster than high-priced homes or higher-priced homes. But during the bust, they also plunge much faster and bottom out a lot lower, which is, again, this is very interesting. I've seen data that shows the opposite of this. But who the hell am I to argue with CoreLogic Case-Shiller? From 2000 through the peak of the prior bubble in 2006, prices for low-tier homes soared 131%. For mid-tier homes, prices soared 108%. And for high-end homes, the prices rose only 90%, which, again, still pretty considerable. But during the housing bust, the low tier plunged about 50%. By early 2012, they were only 18% above the level of 2000. The mid-tier index dropped 39% from peak to trough, but the high tier dropped only 30% and remained 34% above the 2000 level. In the current price run-up, the same principle is at work. At the lower end, home prices have soared 88% from the trough at the beginning of 2012 to the last reading, while high-end homes have appreciated only 43%, less than half as much. Over the last 17 years, lower-tier homes have now risen an average of 4.8% per year, while high-tier homes gained only 3.8% per year despite greater income growth at the high end, the John Burns Real Estate Consulting newsletter said, based on their U.S. housing analysis and forecast, which says, so what does this mean? If you focus on lower priced homes, beware that you are investing in a more volatile section of the market from a pricing perspective, and beware that lower priced homes have appreciated the most. Remember that relatively high home prices can last for years, as they did from 2003 to 2007. So don't panic. And it has a piece of advice when things do turn around. Just consider the risks of lower priced homes as depicted in the chart above, and always be ready to react when the market shifts for the better or worse. There is, however, another aspect than percentages. In dollar terms, losing 50% on a lower or on a low tier home in the 200,000 range is a loss of 100,000. Losing 30% on a high tier home in the $2 million range equates to a loss of 600,000. But for investors with large sums at stake, that's no consolation. Perhaps to battle this situation and have more control over the market when it tanks, the largest single-family rental firms in the U.S., Invitation Homes and Starwood Waypoint Homes, are merging to form one giant landlord with 82,000 single-family homes concentrated in the lower tier. But, as the Burns report says, don't panic. Housing bubbles can last longer than seems possible, and so there may still be a little time left. At the very high end of the housing market, where homes are listed for tens of millions of dollars, BS asking prices are now meeting the axe. Read, whiff of reality at crazy super high end housing market. Yes, and that's exactly that article. Other one goes to talk about what Cliff High said to look for. The high-end housing market is crashing down big. It'll happen first before the rest of the market starts. It starts to happen there. So again, I think in this instance, what we're heading into, as I've been saying all this year, all of this year for sure, high end's going to get axed harder than ever. So even this data I'm reading you, it's not going to account for what happens this time around, in my opinion. Not that that should matter to too many people about high-end housing. Most of my viewers probably live in mid, to lower type, housing, if you will. In other words, the 200,000 to maybe 400,000 or 500,000 range, unless you're in California, city of high-end housing. Maybe some of you are in $700,000 and $800,000 homes. But in your case, those might even be considered the low end, which is unbelievable, in my humble opinion. I don't even want to get started talking about that place. Take care.